Hey, it's Mark Ferguson with Invest for More, and we're back with another real estate video. Today we're talking about mortgages again. We had part one to this video that we just posted, so we'll have a link to that below if you want to see it, where we went over the payment amount on a $100,000 loan, why mortgages were created. It had lots of other really great information on amortization, principal, payments, all of that. Today we're talking about something else. We're talking about different types of loans, ARMs, fixed rate loans, a little bit about 30-year loans, and then we're talking about the money you need to get one of these loans. We're talking about owner-occupied houses, right? Houses you move into and live in. I have a ton of other videos and resources for investors, either flipping, buying rentals. I'll link to those below so you can get to those if you really want to know those. But this is really important to know for almost everyone because most people will buy a house. 67% of households own a house in the United States right now. And then how to put less down, right? So a lot of people think you have to put much more money down than you really need to buy a house. And there are pros and cons to that, but it's good to know the facts and what you actually need. And then how to find a lender. After all this, you figure out, hey, I really do want to buy a house. I know how much money I need. How do I find a lender? We'll talk about that too. All right, before we get into it, of course, make sure you check out investformore.com. If you want more information on this, we have a massive article that goes over how mortgages work and tons of other information on rentals, flips, being an agent, all kinds of free articles on there. And we love to see your comments, so please leave them below. Love to see you guys hit that like button. That helps us out if you like our videos. And now we can get started with this one. So there's also different kinds of mortgages you can get as well. We talked about 15-year versus 30-year. That's kind of the term. When you hear the loan term, that's how long the mortgage lasts before you're forced to pay it off. The amortization is how long the loan payments are calculated off of. So if you have a 30-year loan, your payments are spread over 30 years. That's kind of your amortization. Usually a 30-year loan also has a 30-year term. Now, if you have commercial loans, which we're not really talking about here, you might have a 30-year amortization and a 10-year term. And that means you have to pay that loan off in 10 years or refinance in 10 years. But for most owner-occupants, you don't have to worry about that part. But what you might have to worry about are ARMs, or adjustable rate mortgages. So what that means is a 30-year fixed has the same rate for 30 years. So if you get that 3% rate, that's your rate for 30 years. The bank can't change it, they can't raise it, they can't even lower it. I don't know why they would, but they can't. An ARM means that rate can go up or down. Now it's usually set for a fixed period of time. So you might have a 5-year ARM. That means the first 5 years, you have a fixed rate. You have that 3% rate. After that, it can go up or down. Usually doesn't go down, but sometimes it can. Now, it still might have a 30-year amortization and a 30-year term, which means the bank can't call it due. You can keep the loan for 30 years, but your rate could keep going up and down over time. ARMs were very popular before the last housing crash. They were blamed for a lot of the last housing crash, and they should have been for some extent, but those were like crazy ARMs, like 6-month, 1-year, 2-year ARMs, where they had like extremely low payments, and then they doubled or tripled after 6 months or a year, or some people maxed out how much they could afford because they got an ARM. The advantage to an ARM is you usually have a lower interest rate than the 30-year fixed. However, with the rates as low as they are right now, that's not always true in today's market. Sometimes an ARM has a higher rate than a 30-year fixed because the rates are so low. So very few people are getting ARMs right now because of that, unless your lender might only offer ARMs. So a lot of my loans are through a local bank, a bank who keeps their own money, not a big mortgage company, and they usually only offer ARMs. So they might still do ARMs, but for the most part, your mortgages on your owner-occupant houses, you're going to have no problem getting a 30-year fixed loan with a rate that keeps going the same forever. And if ARMs are more expensive than 30 years, there's no reason to get them right now unless you're forced to do it. I can do another video on ARMs. I have some ARMs myself. I have no problem with ARMs, but you do need to know how they work and what can happen after 5 years, 7 years after that rate adjusts. Usually there's a limit to how much it can adjust, 1%, 2% per year, which still can add a lot to your loan. But you can't really get the ARMs now that were so crazy and detrimental to the last housing crash. And it was really more about overextending people who had loans who shouldn't have loans in the last housing crash. It wasn't just because of ARM. That taught you a little bit about how mortgages and interest rates and terms work. If you want to see amortization schedules, check out like Bankrate or companies like that. Just search for amortization table, mortgage calculator. You should be able to see those and work them out. So how much money do you need to get a mortgage? So we talked about interest payments, how that works. But what about the upfront money you need to get that $100,000 loan? How does that work? Well, the thing is, there's lots of different kinds of mortgages. There's FHA, there's VA, there's USDA, there's even like special HUD mortgages, and there's conventional. So what's the difference between all of these mortgages? All of these are built for owner-occupants, so we're kind of talking about owner-occupant buyers. You cannot use that for investment properties. You can use that, but it'll have a higher down payment. Again, I have other videos on investment property loans that you can find on investformore.com or my YouTube channel. This is more about basic mortgage stuff. FHA is the Federal Housing Administration, and what they do is offer 3.5% down payment loans. So that would be $3,500 on that $100,000 house we're buying. And we did a $100,000 mortgage, but we're saying if you buy a $100,000 house, have a $100,000 mortgage, you need $3,500 down. VA is a Veterans Administration loan. Now that's only for people who've been in the military, active duty. Usually most people who've been in the military in any sense and had an honorable discharge, weren't dishonorably discharged, I should say, can get a VA loan. This is literally $0 down if you do VA. It's amazing, and there's no mortgage insurance either, which we'll talk about here soon. USDA, same thing, $0 down. That's United States Rural Development Loan. Those can only be used in rural areas, so usually small towns, country properties. Depends on what is classified in your state, but like I'm in Greeley, Colorado, where we have 120,000 people, can't use USDA here. But last I checked, in Windsor, Colorado, which has like 15 or 20,000 people, you could. That may have changed though. But it's all based on population and the state verifications on where you can use that loan. Amazing loan too. Conventional, so government-backed, private loan is usually what conventional means. Sometimes they go by government programs still to get those, but it's usually regular banks. You can do 3% down here. Usually it's more typical to do 5%, but they have 3% down conventional loans as well. So you can see, you can get into an owner-occupant house extremely cheap and have an extremely low mortgage payment because rates are so low and because of these programs. Now, if you're doing investment property, you're probably doing 20% down or more. But again, we're not talking about that. There's ways to invest with less money, but for owner-occupants who live in the house for at least a year, that's usually the guidelines for these are the options. And there's also ways, if you have an emergency, your job moves, you're transferred in the military, you don't have to keep living there. You can also get out of those loans if it's been less than a year. So these are some amazing options for putting money down on houses. But that's not all the money you'll have. You'll also have closing costs. So closing costs are other fees you'll have. You'll have let's just say appraisal that you might have to pay for. You'll have flood certification fees, title fees. You'll have some loan fees, origination fee, processing fee, etc. And these usually run 2 to 4% of the loan. So add another $2,000 to $4,000 on that $100,000 loan. So really, you're looking at total needing, anywhere from $2,000 to $10,000, depending on the loan, the down payment, where you're at, and what the closing costs are, because these all vary depending on what state you're at. Some states have transfer taxes, some don't. Some have more expensive title costs, some don't, so that all changes. That's why it's really good to have a really good real estate agent help you and figure out what these costs are, and they can help you recommend a really good lender as well, who can also help you figure out what these costs are, and they should be giving you an idea of what these costs are before you start looking for houses and apply for the loan, so you have an idea of what they'll be. But there's something else that comes into play here for getting a mortgage. We talked about money needed. I think I just erased it. You might need $2,000 to $10,000. Well, I don't have that much money. How can I buy a house? Well, something called down payment assistance. And those are usually state-sponsored programs that help you pay part of your down payment. So if you have a 3% down payment, they might pay all of it. That might reduce your down payment down to nothing. They have something else called seller-paid closing costs. Now, these aren't always easy to make happen, especially in a very competitive market like we have today, where it's very tough to find homes. But you can ask the seller to pay your closing costs. If you have $3,000 of closing costs and you're paying $100,000 for this property, you can say, hey, I'm going to pay $103,000 for this property, but I'm asking you to pay $3,000 of my closing costs. It's the same difference to you, right? You're making the same amount of money. I'm just increasing my loan amount. I'm bringing less money to closing. And you can reduce this down to literally $0 for VA, which is crazy, or $2,000, $3,000, $4,000 all in to buy a house if you're using down payment assistance programs coupled with seller paid closing costs. So you can buy a house for so little money, and now you're controlling a property with a very low payment that you're living in. You're not paying rent. They can go up in value significantly over time, which means you can make 100%, 200%, 1,000% of your money. I know it sounds crazy, but because you have so little invested, if that property goes up in value, you make massive gains on it. So there's always downsides to everything. You'll have some seller costs and different things that go into it. Again, I talk about that in my other videos, but that's why a mortgage and buying a house as an owner-occupant is such a massive wealth builder for most people, because they put little money into it. It forces them to save because they're paying down the principal every month. And when properties go up in value, they make huge gains on their money. All right, something else we need to talk about with mortgages as well is mortgage insurance. So if you're an owner-occupant buyer and you're putting less than 20% down, you're almost always going to have to pay mortgage insurance unless you're doing a VA loan, which has no mortgage insurance. Another amazing advantage of doing VA. So if you qualify for VA, it is amazing. Please go that route. But for FHA, you have an upfront and monthly mortgage insurance fee. So upfront is something, I think, 1.75% now. These can change all the time. I don't know what that is, some kind of arrow. So you pay that when you buy the house. So obviously in a $100,000 house, that's $1,700 you're paying, but it's almost always financed into the loan. Now, you're still paying it, right? It's part of your loan, but it's not an upfront cost. So that's something to consider. And then you have your monthly fee, which varies based on a 15-year, 30-year loan, between 0.45 and 0.8% if your loan is under a certain, I think it's $625,000. If you go above $625,000, those increase even more. So on $100,000, this is a monthly fee, but not monthly cost. It's an annual cost. It's $800 a year. So it adds to your payment, but it's not adding a ton of money to your payment. So mortgage insurance is something to think about, especially this upfront cost that you will be paying, when you sell the house or if you pay off the loan completely. And you'll have a little bit more, $70-some a month on the $100,000 mortgage. That goes up with the higher loan amounts as well. So that's something to consider. Now, something else to consider, conventional loan. This is almost always here on FHA. You can never get rid of it. It's going to almost always be there. With conventional, you usually don't have the upfront fee, no upfront, and then this monthly fee could be the same, maybe a little more, maybe even a little less, but you can get rid of it after a couple years and you've built up 20% equity. Now, on almost all conventional loans, there might be a few you can't do that, but that's why conventional is often so much better than FHA. For conventional, you usually need a little bit better credit score. You usually need a little bit better debt to income ratio. Your lender can talk to you about debt to income ratios and all that, but basically you can't get a loan unless you're making enough money to pay it off, which makes sense. And they calculate that based on your monthly debt to income ratio, your monthly obligations like car payments, mortgage payments like this versus your monthly income. And they want to make sure your percentage is okay. Your credit score is based on what your credit score is. So if you have a 720, 740 credit score, conventional usually is cheaper and better than FHA because you don't have that mortgage insurance and those upfront fees. All right, I know this has turned into a very long video, so we'll try and wrap it up here with some quick tips and ideas here to end it. First off, if you're looking to buy a house, you want to buy a house, obviously you want to find a really good lender. There's big differences in lenders, right? We sell a lot of houses, we sell a lot of flips. I own a brokerage, and we have many deals fall apart because of the lender. And a lot of times it's the same lenders over and over doing it. And the good lenders often almost never have deals fall apart. So you really want to make sure you have a good lender who you're using. How do you find a good lender? You can try your local bank, but there's no guarantee. You can try looking on Zillow, on reviews. My best advice is to get a real estate agent, a really good real estate agent, to give you a recommendation on lenders to use. And I would use an experienced real estate agent. If you're new to buying a house, you don't understand the process, you don't have a lender, just because an experienced real estate agent will have experience with lenders and hopefully give you an idea of who a good lender is. A brand new agent might not have that experience or know who a good lender is. They might just be picking whoever is marketing to them the most or comes to talk to them once in a meeting. So finding a really good real estate agent can help you start the process of finding that really good lender. Once you meet the lender, you'll go talk to them. They'll talk about your finances, your job, your income history. Usually you need to be working for 2 years in the same field to get a loan and a mortgage, so that's a requirement as well. You can't have a ton of debt or you might not qualify for the mortgage. And you need to have decent credit as well. So they'll pull your credit, they'll get an overview of your finances, see your debt to income ratio, and if all that looks okay, they'll give you a pre-qualification letter or pre-approval letter. And once you have that, then you can kind of go see houses, make offers, because a lot of sellers will require that letter before they'll even look at your offer. And it's really disappointing to some people when they go see a house, they want like, oh my God, this is the house I want to buy it. And they haven't talked to a lender. And they're like, we want to make an offer. I'm like, sorry, we won't accept it unless you have a pre-qualification letter. Then they have to go to the lender. It takes a day or two, get that letter, and by that time the house is gone. So a lot of times getting that letter, talking to the lender first is the first thing you should do before you see houses, so you don't get disappointed when that time comes. Now, if you have problems, if you have bad credit, your debt to income ratio is off, the lender can help you fix that. That's the person you should talk to, even if you know their problems. They will help you for free. They'll tell you how to fix it, give you a plan. If things are really, really bad, maybe they'll recommend someone else to talk to. But if you know things are bad, go talk to a lender anyway. They can help you fix it for free. Once you get your offer in, then the loan process starts, you get that accepted. You'll probably have to do an appraisal, which values the property. I have a video on that as well. Sometimes you'll have to pay for that. Sometimes the lender will pay for it. It can be $400 to $800. That's part of your closing costs we talked about before. You probably want to get a home inspection done. Another video, another time I have videos on that as well to make sure the house is in okay shape. The appraisal will confirm it's in lendable shape, livable. So with all of these owner-occupant loans, you need to buy a house that isn't destroyed or gutted, has working electrical, plumbing, heating, no broken windows, things like that. They won't let you buy homes that need a ton of work. That's something to consider as an owner-occupant. So if that all goes okay, your appraisal is good, they go through underwriting to double check everything you told them beforehand. They check your job history, your credit. One thing to remember, don't buy a car. Don't buy furniture on a credit card or a new credit card. Don't get new credit while you're in this process because they will pull your credit again before you purchase a home. And if you have a massive new debt on there, it might kill the whole deal. We've seen that happen before. So be very careful with getting new debt right before you buy the home. All right, one last thing I'm going to leave you with before we go. Talk about finding a lender. You know, it doesn't hurt to talk to a few different ones. Some of them work with different programs than others. There is something called an FHA 203K loan, which is like an FHA loan where you can finance repairs. We said you can't buy a house with too many repairs. That is one exception. So FHA 203K loan. And just a few lenders work with that program. So if you talk to a lender and say, we don't do that, you can't do that loan, it might just be that lender who can't do it. If you want to go that route, it takes more money, more time, it's a little trickier. Find a lender who specializes in those FHA 203K loans. And then something else to consider is how much money you're spending on your mortgage. So let's say the lender says, hey, you can qualify for $300,000. That doesn't mean you should buy a $300,000 house or get a $300,000 mortgage. That means you can. So I'm a big fan of investing. I'm a big fan of saving as much money as you can to invest. I obviously invest in real estate mostly. Well, if I'm always maxing out how much I can qualify for a house, it doesn't leave me much money to invest. So even though they say you can go up to $300,000, there's no rule that says you can't just use $200,000 of that and kind of live below your means, stay below that max number, so you have more money to invest. There's a term that's used quite often called house poor, and that's when you max out as much as you can buy and it leaves you with no other money. All your money is going to the house and it can make it very tough. So you don't always have to spend everything there. All right, thank you so much for watching it. We really appreciate your support, your likes, your comments, all that. So keep those coming. I have 9 books on Amazon if you want more in-depth information on this stuff. How to Buy a House is the one that really covers mortgages, inspections, appraisals, the basics of buying a real estate property. If you want more videos like this, more things explained in depth, let me know in the comments. Tell me what you'd like to see, what you'd like to learn about. I might have already made a video. I have a real estate advice playlist on here. You can go through and see all of my real estate advice videos. Or if I don't have it, maybe we'll make a new one. So let me know what kind of advice, what things you're looking for to help you financially, and we'll try to help you out as much as we can. Again, we'll be back with many more videos, including not just advice videos, but walkthroughs of our flips, our rentals, all kinds of other cool houses. So make sure you subscribe if you have not, and we'll be back soon.